So welcome to this blockchain track on Fintech Connect North America. My name is Anette Brolos, and I'm an independent Fintech consultant. I work with innovation strategy mostly, partnerships a lot. I have a long background in finance and Fintech, and I'm really looking forward to moderate this panel on how we're moving towards a crypto future. And we're not going to dive into the deep specifications of all the parts of crypto. I'm sure that we have a very knowledgeable audience here, so we don't need to do that, but we are going to discuss some of the reactions and some of the potential in this area. And from a bit of an external position, I hear all the comments from one side, the death of Bitcoin being repeatedly announced over major banks now, mostly accepting assets, crypto assets, as an investment object for their customers, over the Facebook coin to El Salvador announcing Bitcoin a legal tender. So I'm really looking forward to hear the experts on this panel discuss how we are moving in this direction and what the potential and the challenges are in this field. I should remind you, audience, that you are welcome to ask questions all along. We will try to draw them in as we speak, because when they fit into the discussion that we are having. And by the end, we will take some questions on other subjects as well. So without further ado, I'd like to ask my panelists to introduce themselves, to talk a bit about your background and also on how you're working with crypto assets today. And Diana, would you like to start?
Sure. First of all, thank you. Thank you so much for having me. I'm very excited about this discussion, and I think you all have amazing backgrounds. I'm the director of ESG and impact at a boutique investment bank called Emergence. We're the team that focuses on blockchain and emerging innovations, but also impact in climate tech and ESG impact within an overall umbrella of Wield & Co., which is basically a decentralized model for an investment bank founded by David Wield, who's known as the father of the Jobs Act, who did a lot of research on how companies are staying private, and there's less and less IPOs, especially within US numbers, and the implications for capital raising and capital formation for innovative and small and medium enterprises. So within that realm, we are obviously supporting a lot of blockchain startups with capital strategy, M&A, and business development across the board. But we have a very startup-y culture. Earlier to that, I advised the Parliament of Cyprus on their blockchain regulation and the risk assessments leading up to the regulation. I'm also a Forbes contributor on topics within stablecoins and central bank digital currencies. And I've also published market research and sets of best practices to provide inputs for policymakers in these areas as well.
Thank you so much. Really amazing. Laurent, would you like to go next?
Thank you so much, and very happy to be here with you today. So good morning, America, and good afternoon, Europe. I'm Laurent Marochini. I'm Head of Innovation for Societe Generale in Luxembourg. I'm also blockchain leader for Societe Generale more globally. So I cover all the countries where Societe Generale is present for all the topics regarding blockchain. So I'm also president of different associations in Luxembourg, president of the ALFI for the blockchain and crypto, so for the fund association, vice chairman of the banking association in Luxembourg regarding innovation and fintech, and president regarding the Luxembourg House of Financial Technology, always in the topic of blockchain and crypto. Regarding Societe Generale and the interest in crypto assets, so we do not touch to the cryptocurrency like Bitcoin, for example. But anyway, regarding blockchain and crypto assets, we are part of the landscape since 2014, and we were one of the first investors in the R3 initiatives. So using Corda, we have made about 40 experimentations since the beginning. 5 to 7 are live right now. And we do focus on 5 sectors where we believe that blockchain will make sense: trade finance, digital identity, cross-border payment, post-trade, so tokenization, and the last one is the insurance. Thank you so much.
Thank you. And Ville, coming to you last, but definitely not least.
Indeed. Thank you very much. And really good to be here back in Fintech Connect again. I really kind of miss live audiences, as great as this is, of course, talking to you over Zoom, of course. So my name is Ville Sointu. I am the head of emerging technologies for Nordea Bank. And since this is a North American conference, I need to mention that Nordea Bank is the largest financial institution in the Nordic countries, where we are funnily not number one in any particular country, but overall, between all the countries, we are number one. Now, my background in blockchain is that, well, I originally started working or investigating the Bitcoin space in 2013 while working for a technology company providing mobile money solutions for mostly for the emerging markets. So back then we were looking at the ability to use kind of crypto assets like Bitcoin for remittance services for emerging markets. And we ended up working with Bill and Melinda Gates Foundation on their remittance framework program as well as GSMA models for remittances. Now, my path then actually ended up in Nordea Bank in 2017. So I've been with the bank now for 4 years, and I joined in 2017 as the head of blockchain and distributed ledger technology. Now, just like Societe Generale, Nordea is an early investor in blockchain and distributed ledger technology. We are part of the R3 family of banks and investors. We are also part of the We.Trade trade finance solution, one of the founding members there as well. And we are indeed in live production with 2 different networks today in the bank. But the topic of today is going to be about crypto assets, and my work in crypto assets in the bank is, of course, mostly related to permissioned solutions, and we're going to get to this kind of naming of different types of crypto maybe a little bit later. But mostly, I've spent my time working with different industry organizations and policy groups, kind of trying to figure out what is the kind of most balanced and best way to regulate crypto assets in a way that it actually would make sense for banks as well. So I am a member of the European Banking Federation's Blockchain Task Force, European Bank Association's Crypto Working Group, and the OECD Blockchain Expert Policy Advisory Board. Yes, that's the way it was said. So a lot of kind of policy influence that we try to do with the bank, and I'm of course doing my best to represent in all of those organizations. So good to be here and looking forward to an interesting conversation.
And Ville, I was actually going perhaps to stay with you a little while, because now I know that I said we wouldn't go into too much detail on the structure and how to build a crypto asset and to exchange it, but there was one thing that we did discuss that we thought that it would be nice perhaps to discuss is exactly what you mentioned, the difference between permissioned and non-permissioned crypto assets, and perhaps you'd like to just structure that.
Yeah, just very briefly and on a high level, because there are as many categorizations of these assets as there are people who write these different kinds of papers and categorizations. So people will always think about this differently. Even on the high level categorization between permissioned and permissionless, there are people, especially in the decentralized finance space, that say that actually that distinction doesn't even matter anymore. It's all just finance and it's running on different kinds of platforms. But from a banking perspective, because we do need to make this distinction between permissionless and permissioned, and the key there is who gets to take part in these ecosystems, and more importantly, or these networks, and most importantly, who gets to dictate who gets to take part. So you can set up a quote unquote permissionless chain, but still control who gets in there. So, but then the question is, who is the entity who kind of acts as the gatekeeper? So it is the kind of access component that in our vocabulary defines permissioned versus permissionless. Permissioned for us as a bank is where we can control the risk of access into the network where these assets are being traded and transferred in. So that means that the counterparty risk for basically, because we know all the participants in the network, goes down significantly. Now, technically, things actually being transferred in those networks can be and are called crypto assets. It's just that they are accessed by a selected group of institutions and individuals, again, to reduce the counterparty risk in those networks. Permissionless, of course, and the audience, of course, is very knowledgeable about this, so I'm not going to go into too much detail, but the permissionless, really the point is that as long as I have access to an internet connection and I have a computer, fairly modern computer, I can download the software and start writing contracts or programs on the network that will execute monetary transactions, and I can get access to all these kind of crypto assets that are being on the network, as long as I exchange them somehow into my wallet. The problem in those scenarios is that they are pseudonymous at best and sometimes completely anonymous networks. So again, as banks, we have very much difficulties maintaining a proper KYC and a risk mapping for those kind of networks, what we call permissionless networks. So again, there are so many subcategories, and probably half of the people already disagree about even this categorization. So maybe it's just helpful to leave it there for now.
So as a broad categorization, it certainly makes sense with regard also to what we're going to discuss further on, how this is going to affect financial markets and regulatory questions. But we'll leave that till a little later. Do any of you two want to comment on this subject?
I think I'll say really quickly that there have been regulatory developments along permission and permissionless. When you classify tokens, there has been some sort of broad consensus to classify the types of tokens as somewhat payment tokens, which would be used to buy goods and services through crypto assets, asset/security tokens, which would be crypto asset representations of conventional stocks, bonds, equities, and conventional assets, securities. And the third category, which is where a lot of the innovations take place, would be utility tokens, which can attach themselves to rights and responsibilities and access to networks before those networks are necessarily built, or have some sort of right in the profits sharing of a company. And that's where a lot of the regulation today has not been envisioned for the form of utility tokens that are being developed, and where a lot of new business models might leverage those capabilities. And those would run within both permissioned and permissionless systems, kind of another layer of.
Yeah, many layers to keep track of when you move in this area. Mm-hmm. Laurent, did you want to make a comment as well?
Yeah, from my side, what I wanted to say is when we talk about permissionless, for me it's like internet, and permission is like intranet. But I will not talk about our conviction regarding one is better than the other, but we prefer working on the use cases and the problem, because sometimes it's better to use a permission system. Sometimes it's better to use a permissionless system. So we have the benefits and the inconvenience of the different system for me. So I prefer talking about the business use cases and the client, of course, and the client, and later about the business model.
And that's actually where I think it's perhaps a good space to start with the use cases. And I think you already, Laurent, mentioned a number of them. So perhaps you'd like to start.
Yeah. I will start with tokenization of assets, because we have an interesting use case where we are working at Societe Generale. So tokenization of assets is definitely a very important topic. And if you take all the different statements in the world and just take the one from the World Economic Forum, because it's the world one, we can tokenize up to 10% of the GDP in the world by 2027. And I heard that by 2030, we will be around 100%. So anyway, we believe that there is a great potential for tokenization of assets. It's a market opportunity of 24 trillion of US dollars. So we can tokenize what we want from the different financial products. We can tokenize the tweet and NFT. So we have seen with NFT, so non-fungible tokens, that we can tokenize also other topic and create new potential markets. We can tokenize precious metals. So indeed, we can tokenize everything, but what is very important is the use case and also the value that we can deliver to the clients. And in Societe Generale, so we have created an internal startup in 2018. So now we have made a spin-off last year. It's Societe Generale Forge, where we have issued 3 times a bond in a public, so in a permissionless blockchain, Ethereum. And so 2 times it was 40 millions, and the first time it was 100 millions. And we see definitely in terms of use cases, when you tokenize the bonds or other financial products, the values that you can deliver to the client and the ecosystem. And especially, and I believe it will be one of the future questions, the impact that we will have on the full value chain of the financial product. So definitely, this is a very interesting and very important use cases for our client and for Societe Generale, with a lot of benefit in the full value chain. So tokenization of bonds and funds are very interesting use cases.
Definitely. So that's a very big area, and as you say, I think we should come back to a little bit hear what the benefits are for the system and for the clients. But I think that several of you also mentioned payments and the cross-border payments as an important use case.
Yeah, exactly. Yeah, go ahead, Diana.
Oh no, I was going to say there's a wealth of different cases. I want to say, especially within financial services. Financial services overall, I believe, has not innovated to the same extent and in the same pace that other industries have. And there's reasons for it, because it's a very regulated space. There's fiduciary responsibilities, but with that, there's a level of risk aversion. And today we're living in a financial system that has been designed during and for basically like industrial revolution, and taking the role and the level of intermediaries, which there's a reason for it, for risk sharing and risk mitigation. But when we talk about innovations in clearing and settlement, innovations where asset tokenization, for example, the marketplaces, supply chain, trade financing, and really reducing the frictions for cross-border payments in a very globalized world where we're still experiencing several hurdles from the current system that we've inherited from generations past, and how through blockchain systems that could really make the world a much more connected place. And along the lines also, we're also living in a place where there's a huge trend toward ESG in the financial services space, and across the board, there's a bigger awareness about the importance of responsible governance. I think a lot of people focus on climate, and obviously in crypto assets, there is a sense of transparency and accountability across the board that could take the form of validating carbon credits and making sure that they are legitimate. But I think overall the focus, a lot of people when they think about ESG, you think of just the E part, the climate tech part, which is important, but oftentimes the climate is very integrated with social issues, and when one goes down, it really affects the other, and vice versa too. So social issues like diversity, or are you treating your workers right, and what's the level of productivity in the workers when they're engaged and they're treated well, and it really all trickles down from governance, from the decision makers, and through open systems of communication that blockchain can provide, you can lead toward just more feedback loops, reducing data silos, and that can look different across different industries, but the overall high level topic is the same. I think one thing that I'd like to point out is that we are living in a connected world, and these innovations depend on networks of engaged users, especially when you're talking about decentralized governance and giving like the power to the people or the power to the users. That really highlights what essentially it's Metcalfe's law, right? If I have a phone and you have a phone, it's not going to be as valuable as if everybody has a phone. So a lot of these innovations within the crypto and blockchain space depend on having that level of networks of users. So you can develop the best innovation, which we've seen a lot of time during the ICO hype, and sometimes even potentially we'll see with DeFi and how that's transforming. But you can have a very promising innovation, but it's not going to scale and it's not going to achieve its potential value if you don't have the level of engagement, and networks are very hard to build from scratch. So tapping into existing networks is something that has been proven very successful.
A very good point to add to the innovation part, and nice to have inclusion on the table as well. Ville, I think we discussed also what I think both Laurent and Anette touched upon, being the efficiency that you can create in some of these areas. You are on mute. Just
unmute, yes. Yeah, I haven't been having good luck with mute lately, by the way. But now I think we're back on. So yes. So again, to take a step back on the kind of use cases a little bit, I mean, Nordea Bank, I mean, all of the banks have been experimenting for now quite a while with different kinds of blockchain solutions, crypto assets. And some would argue that where are all the use cases? Where have they all gone? How is all this investment and all this hype giving any impact or making any impact on the banking industry in general? And then they tend to kind of steer towards the conversation that the banks don't know what they're really doing in this space, and maybe the decentralized finance people do know better or something. Well, actually, I think the efficiency angle there is the answer. And when banks typically, or regulated financial institutions, start looking at these solutions, they want to or need to comply with existing law and regulation. And I know it's an oldest explanation in this space, but the end result, whenever you kind of start building based on existing law and regulation, is pretty much going to be services that don't really look that different from the outside. So they are actually, they might look exactly the same as the solution before, but it might have a decentralized kind of system or network in the background using perhaps some kind of crypto bearer assets to make things more efficient, settle things faster, and most importantly, create an element of digital trust that allows transactions to happen faster. Because one of the critical things in any type of banking industry is that the perceived slowness, the kind of the reason why it's perceived to be expensive to deal with financial institutions and the banks, has largely to do with the absence of trust in this space. So a lot of processes over the decades and hundreds of years of banking have been put in place just to mitigate for the absence of trust. So how do you trust the other bank? Even the banks don't trust each other. No, because that's why we talk about things like counterparty risk, and we need to do KYC, and we need to know everything that's going on, because there is no trust. Then we back these things up with legal contracts, and then it's not only legal contracts in your home country. You also have to in cross-border traffic. You have to figure out the legal contracts of the other country as well, and then multiply that by all the countries that you need to deal with, and you start to understand the complexity of maintaining kind of contract-based trust in these kind of banking networks. Now, kind of move towards what we have today, you add digital networks on top of that. So you add internet and real-time connectivity, but you still have the trust problem in place. And now on comes a solution or a distributed solution like a blockchain that says that we will solve this trust problem for you. Now we have a digital trust element that we can add into this equation, and you can get rid of all the old stuff and everything will be fine. Now, that is not exactly true. You still need to kind of, first of all, understand these trust relationships, these contractual, legal-based trust relationships. And then you need to combine the digital element of trust in order for you to get the kind of benefits that you need to build these networks. And here's one of the lessons learned overall working in this space for some time now, is that whenever we talk to any kind of, well, blockchain company or any type of fintech that says that they will solve either a cross-border payment problem or a digital identity or KYC problem, they tend to focus on the digital part. So they might have the best blockchain solution with all the cryptographic proofs that you ever might need in order to make this digital trust happen. But for us as a bank, it does not matter if there is no legal recourse for those transactions. So you might have a full track of all things that ever happened with a token, for example. But if we cannot identify who was on the other side of that transaction, and we cannot kind of legally go after the person if there is fraud happening, then it's a no-go. You need to combine both conventional contractual based trust with these new blockchain type of solutions, and then you really have an efficient network solution that actually gets you the benefits you need in order to execute all the more complex problems, including cross-border payments. Now, I think this is the core of all the issues we need to solve. We need to bring these worlds together, this kind of blockchain innovation or the digital trust stuff, and then combine that with the law and regulation, and then find a middle ground in order to actually get the scale benefits of these new systems.
It's really great. You just summed up the whole panel
Okay,
in 2 sentences. Well done. No, great. Great. So what I hear is when we look at the use cases and we look at the possibilities, the benefit for the people will be trust, accessibility, efficiency, and innovation. So all great.
I'm going to jump in real quick and say, I
sure,
love Ville's comment on trust, and to build on that, I see a huge potential in revolutionizing the space through smart contracts. And again, like the concept of a smart contract being like not smart and not a legally binding contract, but somehow merging the two so that you get the benefits of an automated transaction, which is what a smart contract basically is, an automated transaction based on a predetermined set of conditions that may rely on oracles or some sort of outside data, but the capitalizing on those automated transactions by merging them within legal frameworks and how to integrate the capabilities of smart contracts within legally binding contractual agreements, and also going back to first principles, like the UK common law, English common law has the basic 3 requirements for a contractual agreement to be legally enforceable. If those requirements are met within a smart contract, how can we make sure that it is legally enforceable, and as a way to merge the two? But that would be a very important element to move forward.
Do you want to comment on this as well, Laurent, or?
No, nothing to comment. Everything has been said, so it's okay for me.
It's
Let me. Can I just try to maybe bring this a lot kind of into practical perspective as well a little bit? So if we look at kind of the history of cross-border payments, I mean, like I said, I used to work in the emerging markets, and there has been a system called Hawala for, I don't know, hundreds of years. Basically, the whole idea, in a very simplified way, is that you're in a city, you find a person and say that I need to send money to this and this person in New York City, or I don't know, Addis Ababa, any kind of place you might want to, and then you basically give the cash to the person. The person puts it into the drawer or the safe deposit box, makes a phone call to the city, to the other Hawala person, to just say, give the money to this person when he or she comes in. Now, that is really a banking system or a blockchain system, however you want to see it, right? Because the money actually never moves physically from that cash box to the other cash box. It is about the trust between these two Hawala agents and the identification of who is sending and who is receiving that cash. And ever since this system was invented, there's always been people trying to replicate these models, some successfully, some not. And in the digital world, we're now seeing the equivalent of this, basically saying that you build a Havala network, call it a blockchain, and then suddenly you're free of regulation. And then that's what we banks tend to steer away from, and we want to make sure that we actually comply with the necessary supervisory components that makes the system work. And again, it's all about looking at the way these things have been historically have been made, and then trying to understand how can we build a digital component of this while remaining within the constraints of the existing law on both sides of that transaction. So yeah, again, it's an interesting way to look at from a kind of a historical perspective.
Definitely interesting to hear about use cases and the potential that you have been talking about already, and also to hear that the banks definitely see this as integratable in their business models. And I think, Laurent, this is perhaps where we come to you, because I'm going to think, how are financial markets going to change if we move towards a crypto future, and including the business models?
Yeah, definitely. When I was talking about tokenization just before, and I took the example of the tokenization of bonds and what we have done with Societe Generale. Tokenization from one side, and we add the tokenization, the cash side was done also inside the blockchain with the central bank digital currency of Banque de France. So it's definitely a very interesting topic. But if you are just taking the example of the value chain of yesterday, the electronic one, and the one of tomorrow will be digital. So before yesterday, it was the paper, and the magnitude of change from the paper to the electronic will be the same from the electronic to the digital. And the primary market, the issuing side, it will be a new channel of distribution. It will be more efficiency thanks to the smart contract, and definitely we have seen already a lot of new players coming in the field of the issuing market. For example, I'm based in Luxembourg. You can think about Tokeny in Luxembourg, and but we have a huge amount of new players in the primary market. After, you need to exchange, you need to transfer the value. So this is a secondary market. The secondary market of yesterday and today, this is the stock exchange. The one of tomorrow will be the digital exchange, and we have seen also the stock exchange that are investing in the lot to find a new place in the future. Euronext, for example, they have done a lot of investment. Nasdaq, it's the same thing. If you're just taking the example of the crypto, it's 24 hours, 7 days, which is not the case of the traditional stock exchange. So also a lot of things are happening in this space. The post-trade, so this is a third element of the value chain, the post-trade elements, the settlement clearing house. You have built an infrastructure with a lot of players, a lot of middlemen, and of course we will see a lot of players moving in this field, because do we need to have a correspondent bank in the future for tokenized assets? For example, today, if I buy a stock in US dollar, I need to have a correspondent bank in US. Will it be the same if I buy an equity tokenized in US dollar, in DigiDollar? So I believe that the infrastructure of tomorrow is going to change. And if we take the different survey, we will make savings of about 20 billions of infrastructure with the digital side. And the last part is digital custody. And today we safekeep the security. Tomorrow we will have to safekeep the keys. We will have to ensure the security of the smart contract. So the value chain will definitely be changed in the future in all the different elements, and we need to be part of the value chain, and we will see a new ecosystem with new players coming in this field, more globally for the infrastructure and in each part of the value chain.
Exactly.
So great potential, and we hear very much the banks being in the space and in the spot also in a future crypto market. So what are your views on that, Diana?
In the future of crypto markets, I think at this point we've mentioned a lot of issues, and also Laurent with tokenization of existing financial assets. I think that's definitely something that's being explored, and in the United States, I can say the DTCC has been working on the pipes and the infrastructure behind clearing and settlement and being able to trade financial assets on a blockchain-based system for several years now. It's going to take some time because there's a lot of transitions to make and the technical specifications that are still being worked on. But it would add a lot of transparency and efficiency to be able to make conventional trades and just the sheer volume that we have, right, in traditional financial instruments, especially the crypto market is a teeny tiny percentage of traditional finance. So that's where really the scale is, right? But when you also talk about financial inclusion, right, the mainstream banking system has not necessarily served a lot of different communities with very niche or very specific needs, whether it be in emerging markets or even within developed countries that could be immigrants or young college students, or there's very specific groups of people with very specific financial needs that the mainstream banking system has not necessarily adapted to in the same ways. So with blockchain-based systems, with open uses of data, that could open a huge opportunity to be able to leverage financial inclusion across the board for a lot of different groups of people. And that's something that we've also seen already, not necessarily in blockchain, but just the use of data through the open banking initiatives out of the UK and what came about it, and the opportunity for innovation and customized solutions. I think also along the lines of financial inclusion, we're seeing the example of El Salvador that just made Bitcoin legal tender and what the implications are. There's a lot of excitement along those lines, but a lot of times, yeah, I just released a Forbes article that came out today on that topic. But basically the point is there's been a lot of excitement, and yes, there is a point toward efficient clearing and settlement, and the case to be made for remittances, specifically for El Salvador, where remittances make about 20% or more of the a country's economy, and they amounted to a record high of 6 billion in 2020. And remittances don't have to be as expensive as they are, especially for the population that can't afford the fees in the same ways. So that's a big draw for the use of something like a Bitcoin-based system. But at the same time, you're talking about financial inclusion, and you're also talking about a country where even though 70% of the population doesn't have access to a bank account, but at the same time, only 45% of the population has access to internet and the infrastructure behind it. So you can say, the president can say, like, I can invest in satellite systems to improve connectivity and broadband, but all those things, the infrastructure behind it and creating that level of infrastructure takes time. And at the same time, with where are the regulatory assessments, right? The assessments of the risks involved, the assessments of the policy considerations involved in order to implement this development in the most efficient and in the best way possible. And we've seen, again, a lot of examples through the industry associations in the blockchain space, as well as a lot of committees out of the EU and out of Asia that have already identified standards and best practices for very specific areas of blockchain, whether it be funds and fund managers or custody, which is probably one of the more challenging aspects to regulate, or just the movements of money and very, very privacy issues. So all those are elements that need to get figured out before you just start using it, right? There's a lot of considerations and assessments that are needed. And to speak a little bit more about El Salvador, El Salvador has engaged the Central American Development Bank to make those assessments to help them in the implementation. It's not just an immediate move, right? There's a lot of considerations.
Yeah, I guess I need to comment on the El Salvador, and then I'm going to continue on a few cases that I've been seeing here in our Nordic markets that actually might be the way to the future. But the El Salvador, again, there's worryingly little details about how it's actually going to get implemented. I think you mentioned some really interesting points. So, for example, they are relying on a kind of an app which kind of custodies the Bitcoin for the individuals who want to hold it in El Salvador, which doesn't even work in the lower end smartphones, as far as I've understood, let alone the fact that most people don't have internet access. Now, they talk about sending internet satellites into the space, but somehow I don't see how that will solve the internet problem in El Salvador, at least not in the next couple of years. Then you hear things like Bitcoin mining on volcanoes, and I mean, it's becoming more of a meme than reality, and that's why it's really hard to kind of know what's actually true about that setup there in El Salvador. So let's park it there, and remains to be seen. I think there are a lot of questions that need to be answered. That being said, we already know that there are good examples of financial inclusion that has already been happening around the world, even without Bitcoin. So I would encourage people who are interested in the financial inclusion angle of El Salvador to look into very well-known cases like M-Pesa in Kenya, completely centralized solution done by the local mobile operator, simply due to the fact that they have basically agents in every corner of the country. So they are able to handle cash with this kind of vast agent network that handles the distribution of money in and out of the system very efficiently. And I think once they realize that actually is the problem, the last mile problem, the distribution, then you're using that distribution channel, combining that with compatible regulation and supervision by the central bank, they were able to build a very efficient system. And that would be a fun thought experiment, actually, if you would take M-Pesa and replace the local currency with Bitcoin. Would that make any sense? I don't know. I need to investigate. But again, I think there's a lot of non-Bitcoin related things that need to be solved in that space. Now, I do want to mention before we kind of head to the questions, and I see a few questions coming in as well. The kind of crypto assets and whether they are here or not. In the beginning, I mentioned that most of these things are invisible for people who actually use these services. So they might look like conventional services, but might be using something interesting in the background. Now, here in Finland, where I live, more than 50% of the entire housing market of Finland is running on a blockchain-based solution. So, in fact, I sold my apartment just 2 months ago, and I did it on the blockchain. And all I did was do 2 digital signatures on a form, and I never even saw the person who bought my apartment. I just left the keys at the apartment. So it's already here. It's just not evenly distributed. The future by me. So yeah, I think there's a lot of really interesting cases already happening all around the world.
And great potential. And this brings me also to the questions from the audience. And I was going to say that with the short time we have, I was going to say that before you answered, Laurent, that we would not go down the alley of the CBDCs, because I think we already have in the conference a specific agenda point for that, although it's very interesting and could give us, if somebody could give us another half hour, that would be brilliant. So, but there are 2 other questions on can digital contracts really go in the place of existing paper-based contracts, which is definitely and also the question of compliance and KYC and AML that is coming for Diana specifically. And I think that this leads very nicely into the large big area that we should talk about. What are the obstacles? And I hear you mentioning 2 kinds of obstacles. One would be regulation, or perhaps the lack of fast evolving regulation, and the other would be infrastructure, like Diana mentioned at the very start, the support of enthusiastic and engaged networks. Mm-hmm. So would you like to start, Diana, perhaps?
Yeah, absolutely. Yeah, it is a balance, and sometimes compliance is perceived as a hindrance toward innovation. and there's reasons why, again. At the same time, regulators, I think, around the world have devoted a lot of time and resources to learn about the space and to be able to respond to these innovations in a way that provides the right safeguards, but in a way that will not hinder innovation. And I think that has required a lot of education and mutual understanding between regulators and innovators. Like, think of, in the United States, the developments of FinHub, and within the SEC, what people like Valerie Sapatnik has done in terms of really advancing knowledge about the innovations from the standpoint of regulators and policymakers in order to make adequate regulatory developments. And I think I'm very confident that good will and has already come out of this, because we do need AML, obviously, we do need KYC, but even through the blockchain itself, right? It's a system that focuses on transparency and open data. So if you think of AML and CFT, that was one of the earlier concerns right now in the blockchain space. Oh, money launderers and the anonymity, but at the same time, all of the transactions are open to the public to see, right? So right now there have been regulatory technology firms that have developed very sophisticated algorithms to actually be able to detect and track and trace illicit funds, and even red flag wallets that hold hacked money or stolen money, to the point where if I can hack a lot of money and put it in a wallet, and these regulatory technologies, I mean, CipherTrace, Chainalysis, Elliptic are examples of the biggest ones probably. And they've had solid partnerships with governments around the world that are using these technologies to identify precisely the illicit activities and the wallets where stolen funds and illicit funds are held. And even if I steal a lot of money and I put it in a crypto wallet, at some point, if I want to convert it to euros or dollars, I have to take it back to the banking system. And there has to be a layer of KYC, because the banking system has KYC, right? So at the point that I want to convert it, I'm going to get caught if the government has their eye on that wallet and spotted it. So in the end, it's like, what's the point of hacking a lot of money if I'm not really going to have access to it, because the government's still going to eye it, right? So that's one very good development. I think on the other hand, because we're heavily reliant on increasingly digital platforms right now, one big risk right now, which I would consider even more serious than AML, would be cybersecurity and privacy and data privacy. But there are ways around it. I think the EU actually released a very interesting paper from the EU Blockchain Observatory, and the Privacy Authority out of France has made very interesting developments on how to reconcile blockchain and the transparency with compliance to GDPR through hashing, through posting on the blockchain codes that have to be through encryption, codes that have to be decrypted and with specific codes, and that's how you can have access to the person's private information. So there's an extra layer of protection, but at the same time, you're using the blockchain. And those are all
here, Anette, but I think perhaps that you covered a good part of the ground, and I see nodding on the banking side, and so perhaps sometimes it's nice to hear somebody else voicing your concerns than just having to do it yourself.
Very quickly, in terms of concerns, the barrier I see is the barrier that we put ourselves, because when you are talking about blockchain, digital asset, it's purely an innovation scheme. It's purely an innovation dilemma, and you just need to cut a branch of the tree when you are sitting and when you are earning money. But tomorrow you don't know if the next branch will grow. So you don't have any return on investment for your future investment. So it's definitely a decision-making, a business model strategy that you need to put in place. For me, in terms of regulation, they show that we are quite confident with the regulator. They are very open, because blockchain and tokenization is an excuse for competitiveness of the countries. What we need to have is an harmonization of all the different regulation, not only in Europe, but all around the world. That's it for me.
And Ville, would you like to have the last word then? Because I think we're running out of time.
Yep, I think the key things to solve is identity and legal recourse. Identity, we're already seeing a lot of good things. There are already existing digital identity schemes. And now, for example, European Union just proposed an EID or European Digital Identity Scheme, which actually relies on blockchain type solutions for self-sovereign identity. Very promising. Legal recourse, again, the connection to legal recourse is regulation and laws. So again, if we're able to make laws that work in this new digital world, I think we're going to be able to solve a lot of these issues that we're seeing, especially with regards to consumer protection when the markets come crashing down.
I'd like to thank you all for sharing your insights, and it's been brilliant to hear that the future is here, just unevenly distributed as usual. So, so good potential, but also some work to be done in the future. So thank you very much to our brilliant panel, and thank you for the audience for keeping with us all the time. Thank you.
Thank you. Thank you. Have a good day.
Thank you.